All right. So what do we have in prediction markets?
So we got Polymarket launches institutional research division with analytics subscriptions, Polyperps. So we're launching Polymarket institutional research, original research built on our markets, direct from the institutional desk. Our first issue looked at Anthropic's valuation strip and whether the right tail is underpriced. Last week, we tuned to the Strait of Hormuz, where traders price a 62% chance of normalization by the end of the year. We'll see if what Scanna says about that, and what that implies for the spread between Brent and yeah, the oil.
Wow,
Uh,
that's good. But I
but
wonder what kind of analysis would they do? Let's see here.
yeah, let's see their research.
Well, it's weekly market briefings, deep dives on events and discussions. This is awesome. Like we
Perfect.
can go even deeper. All right, next.
Next, Clarity Act, Senate vote markets spike on Kalshi and Polymarket amid Trump ethics breakthrough reports. What is this?
Well, whether or not like all these like regulations are gonna actually be become law, right? So there's now prediction markets for it. Like it's funny. It's the irony.
Yeah,
Will this bill pass? It's like
that bans our platform or not.
yeah.
Yeah, it's kind of funny.
Okay, next.
Kalshi and Polymarket open interest drops 20%.
Well, it's no surprise. FIFA's over.
Yeah.
So
But at least is it still a little higher than before FIFA? Or did it completely go below FIFA
I
levels?
think so. I think it's
Right?
overall. I mean, it's just yeah. Overall, people are like, oh, okay, it was that easy because you're getting credits too. Like you open up an account, you're getting $200, $300.
Yeah, exactly. So I still think they still gained new users, more traction. Even if it dropped 20%, I think they're better off now than where they were before.
Well, the question is like, is it sustainable business, right? And the walls, in terms of regulations, are closing in, but the market, we're seeing new entrants, new players. Yeah. So next.
Polymarket launches new Ukraine military leadership market on Bloomberg.
No way. Jeez.
I tried searching it, but I couldn't find it.
Yeah, I don't see it there. Okay, next.
Manifold market on Kimmy Moonshot. IPO before 2028 jumps 80% yes on fresh Bloomberg News.
I mean, they're trying really hard right now to crack down on anybody who wants to host these models here in the US. But the question is like, well, how do you make money if you're open source? We'll host the models. So these things are massive and large. Like the average person can't host these things. And they require special. It's not like, okay, just go ahead and install this on a server. It's like, no, it's much more complicated than that. They seem
Yeah.
to be like kicking ass, but it doesn't mean like you can just whip it, come here, install it, and it will work.
I literally wanted to cancel my Claude subscription.
There's so much more that goes into just
I
aside from
know.
having a model, right? It's
No, I know that it's the harness, but I've just reached the point where I'm just so fed up with Anthropic. Like I don't know. I'm just sick of using 4.8. The shit that they did with Fable.
5 is extended.
Yeah, now it's part of the plan because of how big, Kimmy K3 was, right?
So
And
remember that market we were looking at? Would it extend?
so that's the thing. It's the rules. What were the rules of that market? Because it wasn't an extension for everyone. It became part of the plan. So how do you resolve that market depending on the rules? Can you pull it up or
I'm trying to
send it
find
to
it,
me?
but it was a small pool. I mean, it's a small. It's interesting. So but why are they doing this? Well, look, Kimmy.
Yeah.
Go figure, right? So it's good. It's good that we need more competition, right? So the consumer wins in the end, right? Like we have more choices, more services.
And it's open source versus closed. That's a huge thing as well.
Open source, open weight.
Yeah.
Okay. Next, let's go to DeFi.
Allbridge core pauses after 1.65 million flash loan exploit.
It's like all the stuff that's in DeFi is always like exploits.
Uniswap governments votes to activate V4 protocol fees across major chains, including Robinhood chain expansion. Okay. Hyperliquids, HIP4 advances permissionless deployment for outcome markets.
Yeah, but you need like 500,000 hype tokens, which is like what, like $65 a token. So you're looking at like $30 million to stake.
Yeah, that's true. Natural raises 30 million Series A to build payment infrastructure for AI agents. Natural views Stripe as its main competitor. Several other startups, including whatever, are trying to reinvent the payment backbones for AI agents using USDC-backed stablecoins. While Natural plans to incorporate stablecoins into its architecture, also building support for traditional. Okay, whatever.
So-
Cascade raises 3.5 million seed from A16Z speedrun. Cascade, the AR startup that predicts where major construction projects will happen next, has raised 3.5 million in seed funding.
We applied to a speedrun, did we not?
We did.
We didn't get it. For AI construction projects predictions. That's a very niche, very, very niche. Interesting. Okay, let's move off. I think that's it, right?
Yeah, and then markets, the only interesting ones I see here. So it's all like, I think this is tennis. There's some Counter-Strike markets, and then the Fed. So will the Fed decrease interest rates by 25 basis points after the July 2026 meeting?
Will they, decrease? And it's going to, no, inflation is high. So they want to keep interest rates high. So they're hawkish. They're not dovish.
Well, what does the chart say?
99% no. So
Yeah.
chances are they're not decreasing it. Like, even though, people are like, they need access to capital, lower the cost of borrowing. If you do that, inflation is high, and then it's probably not going to do make any difference. So you may lead into stagnation.
Yeah, and then we got 50 basis points, which is also predominantly no.
So on
Tech Brothers?
On the Tech
Not
Brothers, yeah. So they
Brothers?
had Tarek on there. I didn't get a chance to see it, but
Let's see what they say.
Yeah, I mean, I think that it really is anyone who is basically a natural long or a natural short on compute. So anyone who naturally benefits from compute prices going up, and anyone who naturally benefits from compute prices going down. And for both of these cases, what we're starting to see is, for the first time in the last year, compute is not in this sort of a continuously decreasing trend. And that's kind of a healthy dynamic to build a derivative market on top. And so anyone who's a natural long will over time want to take a short position and vice versa to manage the risk, right? So it becomes natural for you to basically want to smooth out some of that exposure by hedging it on the forward curve and over time on the futures curve. The rule of thumb is every time you have an underlying market where people are transacting the spot, which is buying and selling the thing.
Yeah.
When you overlay a derivative market on top of it, historically, if that market has any degree of success, it ends up being at least 10 to 15 times the underlying market.
Okay.
Because, the way that these markets evolve is obviously you get the exact insurance use case, the hedging.
Yeah.
But that tends to be usually like 5% of the entirety of the liquidity in the market. The rest is speculation and people arbitraging and doing a lot of other things. And so those markets tend to be very, very large.
Yeah.
And I think the compute as a commodity is going to probably be the largest commodity on the planet. And so the derivative market for it will probably be the largest derivative market on the planet, outpacing treasury futures and a bunch of other things.
So did he say how many times multiple?
10 to 15 times.
Go back.
Go
back to it.
The rule of thumb is every time you have an underlying market where people are transacting the spot, which is buying and selling the thing.
Yeah.
When you overlay a derivative market on top of it, historically, if that market has any degree of success, it ends up being at least 10 to 15 times.
What does that mean? I have any degree of success. It means like if there's liquidity, like
if there's
regulation,
liquidity,
all that stuff, right?
Yeah. If there's actual liquidity and there's volume, it should be 10 to 15 times larger.
And
like the options market is I
Yeah.
think 20 times larger or more than the stock market.
And what about second order derivatives?
A derivative of derivative.
But anyway,
But to this, I don't really have anything to add. I kind of agree.
so he's compute as a commodity, right? So he believes that it would become the largest commodity. So it's just like, oil and gas. It's like, well, compute is a commodity, and it will be bigger than all the other commodities. And then there will be a market for it. Like, why not, right? Because I mean, what are all these computes doing? Well, the ability to be able to generate tokens, right? Intelligent tokens to be able to do a task. It's pretty smart.
Yeah.
Compute as a commodity, and you traded it with the CFTC. GPU futures. So they're launching a GPU future to establish a forward curve for compute resources, right? Being able to know how to to anticipate capacity, because that's the bottleneck. So, but it doesn't mean like it may actually force people to alternatives. Like if China is cut off from the high-end GPUs, they'll just say, okay, fine, we'll just adapt and build our own. So very interesting. Now, did you want to go over? There was a research paper.
Well, there's the Wealth Simple trade show that we can go over, where he talks about the growth that he's had with Kalshi, exponential growth and scaling. Kalshi has experienced massive growth, moving from millions in daily volume to over 1.1 billion in daily volume in June. Tor explains his management philosophy by focusing entirely on the single biggest existential problem, the hole in the boat facing the company. What is this?
You're doing all this. What keeps you up at night?
You know, I think it's
Regulations.
that also always changes, right? I mean, maybe the analogy I like to think about. So I think any company, you can think of a company as like being on a boat. Like you're a captain and you have your crew and you're on this sort of boat and you're sailing these like sort of treacherous waters. And at any point in time, and this is, if you're a seed stage company all the way to a Fortune 500, like there's like a hole in the boat. There's some problem that is, difficult, that is potentially or probably existential. And I think there's two types of companies. There's companies where the founder and the CEO is essentially staring at that hole all day, all night until it gets resolved. And companies where the founder CEO is kind of busy steering the wheel and has like a bunch of sort of, execs and managers and other things around, who end up also delegating to people who end up delegating to some random person in the team that's supposed to be fixing that hole. And really what happens is the hole ends up being covered, like a sheet over it. Like they just cover it. They forget that the hole is there. And then all of it, a decade later, the hole ends up being swallowing the boat. And so I think consistently our frame is like, what is the hole in the company? And that's the one that I should be looking at. We have to get the public we have to educate the public, the general public, on what prediction markets are and how they work. I think we hit mainstream earlier this year, and I think, with technologies, you sort of get like, it's like exciting. Everyone is excited about it. It's new, it's novel, it's interesting. And then you hit mainstream, and then people don't perceive it anymore as like a new underdog type thing. And then people get skeptical. It's happening with AI. In America, AI is polling at 90% disfavorable. It's like incredible. It's crazy. It happened with crypto. It's happening with prediction markets. And I think one of the core responsibilities you have right now is educating people how they work, why they're a force for good, why they're significantly better than any other financial market at doing the specific thing of expressing a view on something, and then what are the risks and how do you mitigate them, and why the risks themselves are not sort of dispositive. Like any financial technology, it comes with a set of risks. We have to figure out how to solve them or reduce them so that the technology can thrive. And I think that's the key role right now.
Well, that should be like our main focus. Continue to focus on that aspect.
So I was gonna say there's a couple things. One is like education. What do we do pretty much all day? We're educating. Well, we touch on AI and a whole bunch of other stuff, but like in terms of prediction markets, like we do a lot of education. So, but the other thing I want to say is, what do you think our hole in the boat is? I have an idea of what it is.
I don't think we even have a boat.
What is the hole in our canoe?
Well,
the existential, like this is basically like the existential problem for Scanna. It's visibility, like being known. No one knows we exist. It's complete. It's a distribution, a marketing problem.
Yeah, I mean, you and everybody else. Unfortunately, right now, to capture attention on YouTube or on social media is that you have to be very controversial, right? You live in this bipolar world, and you have to say something that's shock and awe, and then people will tune in. But then you just like, it's a gimmick. But the fact that people don't know us, it's like, okay, well, what are we doing about it? At least you have the self-awareness that it's like, okay, we have, like any other company, it's like, does anybody know that we actually solve this problem for you? Like, chances are, no, they don't know. It's like, so you have to get up and start talking, like educating, right? Like, let's fire up Scanna and start going through these markets, deep dives. Actually take that research that they just published from Polymarket, the institutional analysis, right? Well, you just signed up, right? So, and you take that and you analyze it and you go in depth and you're like, okay, this was insightful. Especially right now, if it's like those two worlds are colliding, AI, compute with prediction markets, like that's what we do on a daily basis, right? We understand it better than the average person, right? And then people will recognize the value. They're like, this was really insightful, this was really valuable. And unlike the other, like every other podcast, it's like a million sponsors at the bottom. It's like how much freedom do you have to be able to be authentic?
Yeah. They can't say Microsoft.
No, they can't. So I think the main takeaways here is that, look, the holes in the boat, he doesn't delegate them. He actually goes and fixes the holes themselves.
Yeah. I mean, isn't Elon the same? He focuses on the biggest problem in each one of his companies.
Well,
whether
how
it
do you
was
split your
Tesla,
time
whether it
between
was...
all those companies? Yeah, it's ridiculous how you can able to like come in and just like.
Well, it's because he only focuses on the biggest problem, right? And I think it was Bezos who was the one who said, like, no team should be greater than... You shouldn't report to more than like 3 people or something like that.
No,
It's like
2 pizzas.
2 pizzas, right?
2 pizzas, right? And I think the same philosophy is here. It's like, keep this team small and nimble. Focus, the holes, those are like the urgent existential threats, right? To him, it's like the regulations. Rather than delegating them away, a strategy applies to managing Kalshi through its rapid growth. Education. There's this negative perception. Yeah, okay, fantastic. That's good. Speaking of probabilities, right? I do wanted to cover that research paper that just got published recently. So it's called Prices, Probabilities, and Parlays. Okay. So a systemic bias in sports prediction markets. And so what they did was they looked at 23 million moneyline trades. They found that their models needed to be calibrated, especially in the last 10 minutes. A contract's price is highly accurate, so it's very well calibrated, right? Because when you look at the price is the probability of the event, right? This is the beauty of the prediction markets. So it's well calibrated and accurate in the middle of a game. However, in the final 10 minutes before settlement, prices heavily distort. Why? It's because people are like, oh man, I'm going to lose my position. So they go and they say, okay, looks like my team is going to lose, so I better go and buy the other. Right? So they can limit their losses. And so as a result, it's like you get this like distortion. So it doesn't reflect the probability. And so because people are hedging. So in the last 10 minutes before settlements, prices heavily distort. Traders with losing bets, they panic, right? They go crazy. And then they overpay to hedge, right? Because it's like, oh, you want the yes now? It's like, you know what I mean? You're going to have to pay a premium for it. And so traders with losing bets seemingly panic and overpay to hedge their losses. Similar to buying expensive insurance. So, right? So it's like, oh man, I need that insurance. Causing the price to probability relationships to break down into a step-like curve. So then it's like, okay, you need to like use a different method to calibrate, especially in the last 10 minutes. If you have a bot that's only going to trade in the last 10 minutes, you can just buy the obvious, right? What's the probabilities of like, if you always trade in the last 10 minutes, chances are you're going to have a sort of a winning outcome, a successful outcome.
You might lose to a couple black swans, but yeah, no, over the long run.
But in the long run, it's like, is this a 90%? So then you can have like one strategy, which is like, I only trade in the last 10 minutes of a resolution, provided that, you know, the fees don't eat up into your like profits, right? But then there was something interesting more in there. So that's like one leg, right? It gets even more complicated when it's a parlay. You've got multiple legs. So you can't just say, it's like, well, that's, you know, we need to take that as into our calibration, right? This is not just one condition. It's actually becomes much more complex. So in parlays, systemically overpriced. So they're always like, so when combining bets into cross-game parlays, the platform charges a hidden markup. A parlay is consistently priced higher than the multiple probabilities of that individual leg. So when you take all those contracts and you calculate the probability mathematically, you're like, it should be here, but then it's like you end up paying a lot more, significantly a lot more. So it's like higher insurance, premium insurance, because you made the wrong decisions, right? So this overpricing grows significantly as you add more legs to the bet. So this is not like, damn, like we need to put this as a calibration step. So here it is. So sorry, I was going to show you that graph. So as you can see here, this is like 0. So like 0, that basically it expired, right? The market resolved. And this is when it's like 360 minutes to expiry. So when it's far away. So somewhere in the middle, so let's say, for example, this market right here. Well, it's log anyway. But as you can see, like you can get this calibration. When you're getting close to expiry, to resolution, there's a huge deviation, right? Like you have to calibrate because they're not a reflection of the true probability of that contract.
When they say fair, how do they define fair? So fair just means accurate, or because fair is y equals 1.
Are you looking here on the left?
Yeah. So what does that mean? Fair does that mean? How do they define fair?
The probability. Like fair is probability.
Like the accuracy of the probability.
The probability, like if something's priced at 80 cents, it's like, well, is the probability 80%? It's like, yeah, it's 80. Then it's okay, that's fair. But if something has a probability of 80, but it's trading at 90, that's like, well, you're paying a premium.
I see. Okay.
So they're finding that in a single contract, but then parlays, it becomes even more exponentially difficult, and you end up paying a huge premium. Especially, look, you have like 12 contracts.
Why is there a drop at 6?
I don't know. It's interesting. It's like we can take a look into it.
Yeah.
Something about 6. I don't know. It's weird. Yeah, that's an interesting observation. But overall, you stand back and you're like, yeah, I mean, I would expect like you have to take that probability, given this probability, like becomes increasingly complex, but then you end up paying overprice. There's an overpriced parameter that they've calculated, right? So 0 means like it's not overpriced. That is like if you just take them at face value. So 12 legs. Who the hell is doing 12 legs? I don't know.
Oh, that's fucking crazy.
Right? So then they go into the actual evidence, and they show like, okay, the last 10 minutes, 30 minutes, 240 minutes, and here's the market price, right? And how the price is fluctuating. So you get this like huge deviation. Your calibration breaks down, so you have to try other methods. And they go into the different types of methods. So
anyway, I'm gonna take a break, and I'll be back. I'll let you know when I'm gonna fund the wallet with USDC, so we
Yeah,
can
yeah.
do it for
Let's
it too.
capture it. Let's capture it live.
I mean, you remember when you did it with testnet money, right? The QR code popped
Yeah,
up.
yeah,
Yeah.
yeah. Okay. I'll work on getting that video uploaded, and then start working on the next one.
Okay.
And then you focus on the short form right?
Yeah.
All right.
Okay, sounds good.
Talk to you
Bye-bye.
later. Bye.